Okay, so if you really want a shortcut to being, a smarter investor, you kind of have to understand Warren Buffett's approach. His whole integrated framework he's used for, what, 6 decades?
Yeah, it's quite something. We've looked at his system. It really blends that defensive mindset with, a focus on high-quality businesses and critically, that behavioral discipline.
It really all starts with Benjamin Graham, his mentor.
Absolutely.
Yeah.
The whole thing rests on one really key idea. You've got to separate the market price
Mm-hmm.
from the actual business value. Buffett has that famous line.
Right, yeah. Price is what you pay. Value is what you get. Simple but profound.
Exactly. And that distinction, that separation, it leads straight into what Buffett thinks are the three most vital words in investing.
Margin of safety, right? It's like a buffer zone. I always think of that engineering analogy. You wouldn't drive a huge truck over a bridge rated exactly for its weight.
Precisely. You want massive overkill capacity. That margin of safety, the MOS, it is a defense, yeah, but maybe its biggest job is psychological. Graham had this concept of Mr. Market.
Your manic depressive business partner. Love that description.
Right. One day he's euphoric, the next he's panicked. When Mr. Market inevitably freaks out, having that MOS, having bought way below what the thing is actually worth, well, that's what keeps you from freaking out and selling low. It's a mental cushion.
But the framework evolved, didn't it? It wasn't just Graham forever. Charlie Munger stepped in.
Big time.
Yeah.
Munger really pushed Buffett away from those cigar butt investments.
Yeah.
The mediocre companies that were just super cheap.
Right, finding that one last puff.
Yeah. Munger's view was clear. Far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
That really changed the game. Quality became paramount.
Which meant they needed a way to measure that quality rigorously.
Definitely. They moved beyond just looking for cheap and started digging into operational excellence. The key metric, the real acid test, became returns on capital ROC.
How well does the business make money using the money it already has? That's it in a nutshell. Buffett would much rather have, say, a brilliant $10 million business earning 15% on its capital than some huge, sprawling $100 million giant that's only making 5%. Efficiency matters.
Okay, and talk about quality inevitably brings us to the moat, the economic moat.
Yeah, the moat. It's just that durable competitive advantage.
Yeah.
Think of a castle. The business is the castle, and the moat is what protects it from invaders, from competitors.
And it has to be durable, right? Something that lasts.
Absolutely. Low costs, network effects, maybe a powerful brand, something structural that lets it withstand the storms of time, as they say.
Okay, so let's talk Apple. Big position. Seems like a tech bet on the surface, which feels a bit different.
Well, yes and no. They don't really see it as a high-risk tech play. They view it more like a really stable consumer franchise.
Because of the moat?
Exactly. The behavioral moat. That ecosystem is incredibly sticky. Once you're in, you tend to stay in.
Yeah.
Plus the brand loyalty, the reliable cash flow.
Got it. And to figure out what it's worth, they don't just use standard earnings per share.
No, they use their own metric, owner earnings. It's basically reported earnings, plus depreciation and amortization. But then, crucially, you subtract the capital expenditures needed just to maintain the business.
So stripping out the accounting noise to see the real cash an owner gets.
You got it. How much actual spendable cash does the business throw off each year? That's the question they're trying to answer.
Which brings us to maybe the hardest part, the behavioral side. We often think risk is just volatility, stocks bouncing around. Buffett sees it differently.
Totally differently. For him, real risk isn't beta or volatility, it's simpler. Risk comes from not knowing what you're doing.
Plain and simple, lack of knowledge equals risk.
And the only antidote to that risk is discipline. Stick rigidly inside your circle of competence. If you don't truly understand a business, how it makes money, its competitive landscape, you just don't invest, period.
And that understanding, that competence, is what allows for real patience.
The kind of patience where your favorite holding period is forever, because you know what you own. It fuels that belief that the market is basically set up to transfer money from the active to the patient.
So success isn't really about having a genius IQ, it's more about emotional control.
It's almost entirely about temperament and having a sound intellectual framework. Resisting panic, resisting fads. Understanding why this time is different are often the most dangerous words in investing.
Okay, so boiling it down. You've got Glam's margin of safety for defense, and Munger's focus on the moat for that long-term compounding.
That's the dual engine approach, yeah. Defense and duration. So what's the practical takeaway for, most people listening?
Well, let's be realistic. Most people don't have the time or, frankly, the inclination to deeply research moats and calculate intrinsic value. So, sticking to your own circle of competence often means.
Low-cost index funds. For many, probably most investors, it's the most sensible path. Lets the market work for you over the long haul.
Right. And maybe even before investing, think about Buffett's rule number one: never lose money.
Which starts with personal finance. Getting rid of that high-interest debt like credit cards. That's just an unnecessary anchor dragging you down.
Good point. So let's leave you with this. Think carefully about where you put your capital. Focus on productive assets, things that actually generate cash flow, like solid businesses or income-producing real estate.
Yeah, steer clear of purely speculative things where your only hope is that someone else will pay more later. Make your money work. Don't just hope its price goes up.